Good morning and welcome to another episode of Faith and Finance. I am your host, the Guardian Voice, with my co-host, Mr. Ben Samulak. And today we have decided to raise the question, how much capital do you need to trade live in a futures or forex account? This is a very important question that we raised today. And before we get started, as always, we want to go to God in prayer. Dear Lord, we just want to thank you for the opportunity to raise this question. It's very important, and all of our listeners and traders need to know what it takes to trade in a live account and how to do so properly and professionally. Dear Lord, give us this day our daily bread, as you say and teach us in the Lord's Prayer, and forgive us of our trespasses as we forgive those who have trespassed against us, and lead us not into any temptation, but deliver us from all evil. We just thank you, Father God, for the time to help those. And without further ado, let's go. All right. So, how much money do you need to trade for a living? Everyone's seen this guy? He's very friendly, outgoing. He works for TradeStation, Interactive Brokers, Forex.com, Ninja Trader, and they're always here to help you open up the account. Hey, if you've got $1,000, $2,000, come on in, bring it here, and we can get you can yes, you can trade. Yes, you can start trading with $1,000, $500. But the problem is, a lot of times that's not the best advice. And if they just want to open an account, be careful. Okay. So we have our risk disclosure. Futures, foreign currency, and options trading involves substantial risk and is not appropriate for everyone. Also, this presentation is for educational purposes only, and the opinions expressed are those of the Guardian Angel and the Guardian Voice. All trades presented, though we're not trading today, but should we trade, they should be considered hypothetical and should not be expected to be replicated in a live trading account. When we do trade, it is typically live. However, we definitely advise you to trade at your own risk and discretion if you follow any trading that is involved. Not today. We're going to talk about live trading. We won't be actually participating in any live trades today. So, to start trading in a live futures or forex account in the United States without over leveraging, the amount of capital required depends on the specific market you are trading in and your broker's requirements. So again, that's for example, if you're with Charles Schwab, now who also manages Ameritrade, Thinkorswim, if you're with TradeStation, if you're with Ninja Trader on the future side, you Forex traders may be with Interactive Brokers or Oanda.com or Forex.com. All of these brokers have minimum capital requirements and they can provide the information. We will highlight that uh, here as well. So let's just get started with trading futures for beginners. You futures traders, I love trading futures, and I know many of you trade commodity futures. So, what does it take to do this in a live account with real money? That's so important. Show me the money. Show me the money. That's what he said in that movie, right? Show me the money. Show me the money. So I'm going to show you the money. Okay, so for futures trading, the margin requirements. Futures contracts do have a margin requirement, and that is essentially the amount you need to deposit in your account just to hold a position, just to enter a trade. This margin requirement is set by the exchange, so it's not set by the broker, it's not set by me, the Guardian Voice, it's not set by anyone but the the Commodity Futures Exchange, and it requires slightly higher margin levels in many cases. Initial margin for a standard E-mini S&P contract, and this is from a historical context, can range from 2,000, and I would say I wouldn't cap it at 6,000. I would say 2,000 and higher, depending on market conditions. When I started trading commodity futures in, I believe, maybe 2012, you literally could trade one E-mini S&P contract for this $2,000 uh, low end of this range that we have highlighted. Not so today. Maintenance margin is usually lower than the initial margin, but ensures you have enough capital in your account to cover potential losses. So it may be less than the 2000 or the 6000, but it's still quite a bit. And this can range for, this example here from $1,500 less than the 2000 to 3000, and that's less than the 6000 for the same contract. And maintenance margin is to maintain maybe a position between sessions or intraday. Capital to start. And we like to think in a small account. So obviously, if you're independently wealthy and you have an abundance of and just an overflow of money, that's easy. But what is it that the small account trader need? This is key and crucial and critical. You must take note. Uh, I'm going to give you some homework to go to the CME website because this information can change. It's very real time when we talk about the live account. But if you're starting with a small account, you might want to consider starting with at least, I would say, the top of this range, not the 5,000. You can, but you're limited to what you can trade with the 5,000 all the way up to 10,000 to avoid over leveraging and give you a cushion in case of market volatility. But to be honest with you, if you were wanting to trade the E-mini, and today is March 4th of 2025, that $10,000 top of the range would not be enough to trade one contract. And this shows you how history changes, and time can change. Nothing stays the same. But $10,000, and I will be highlighting this and going into this, but it's not adequate. It's not enough. So you need to prepare and know these numbers and figures. Some brokers offer mini or micro contracts, which are different products with lower margin requirements, and they have is created these new products now, so you don't have to have as much to get started. But they don't. The risk to reward trade-off is much lower. When you trade an E-mini standard contract, as you know, that's $12.50 per tick of profit or reward. When you trade a micro, it's only $1.25. So that's quite, a difference for the risk to reward trade-off. Now, for forex trading and for beginners, forex trading, it's a little bit less stringent. In the forex market, margin requirements are typically much lower than in futures. For instance, forex brokers in the United States in particular offer leverage up to 50 to 1 for the major currency pairs, though the majors are like the euro USD, the pound dollar, the dollar yen, uh, the dollar CAD. There's a few others, but this means you can control a $50,000 position with just $1,000 in your account. Now, however, the amount of capital required will depend on the broker's policies and the currency pair you're trading. I remember meeting a young trader in the beginning of my trading journey who trades probably to this day, if they're still trading, but this trader would only trade the Euro USD major pair. There was a 2%, and it's probably still, I think I looked the other day, it's still 2% to trade one standard lot because Forex defines them as lots or units. A standard lot or unit is $100,000 of currency. So you're controlling $100,000, and that percentage that you're required is 2% to control one lot. So that's $2,000 to control $100,000 of currency. So if you want to have two standard lots, that's 2,000 times two, which would be 4,000, and so on and so forth. So capital to start. To trade Forex without over leveraging you ideally want enough capital to absorb losses without risking your entire account balance quickly. So here I would say, and this is just my recommendation, it says for conservative trading and to reduce the likelihood of a margin call, and you never want a margin call. That's when the broker says, hey, Mr. Guardian Voice, you need to deposit another $2,000 because your account has come down to a negative $1,000 balance, and we need you to bring that to initial margin or maintenance margin. You need to deposit another 2,000 or 4,000, whatever the threshold that you came below requires, and they'll let you know, and you don't want that call. So I would suggest trying to keep your margin proper. And so again, we would recommend for your forex trading starting with 10,000, and that's to provide more flexibility and safety, depending on your risk tolerance, what you're trading, and your trading style. If you're more aggressive means more capital, more of a budget, because you're a straight shooter. You take on more risk. And we don't believe in gambling. We believe in managing risk. So that's going to lead me to my next consideration here, leverage management. You need to be a great risk manager if you're going to be a successful and consistently profitable trader in the world of trading. Even though brokers offer high leverage, it's your responsibility and advisable to avoid using maximum leverage. This can lead to significant risks, especially in volatile markets when markets are swinging back and forth, and it does happen, particularly in forex and futures. One news announcement can violently cause the market to change and shift, and you will see your account wiped out if you're not careful. A general rule in trading is to never risk more than 1 to 2% of your account balance on a single trade. So I like this number of $50,000. 1% of $50,000 is $500. And if you start with a $5,000 account, you can see that that's not a lot of risk. You should risk no more than $50. So if it's a $5,000 account, but once you get familiar with these products and how they move, $50 of risk is 4 points. That's only 4 points, 1250 times four, and that's not enough. That's not enough to, in my humble opinion, especially on, you usually when you're managing risk and your stop loss, you want to give yourself some cushion because, when you're in a trade, it can come against you, usually 250 to $300, and you could be right, but it may pull back a little bit. But $50, if you only risk $50, which would be following the rule, so you have to learn, am I risking on a proper amount to what I'm trading? Now, if we stay at $50, and I mentioned the micro, it's $1.25 on a micro lot. Well, that's different. It's almost a tenth of uh, the size of 1250. So it's a tenth or $1.25. So that's equivalent to a $50 risk is equivalent to a $500 risk on a S&P E-mini lot. So, you can make that relative, but again, you're only getting $1.25 per tick versus $12.50 per tick, but it's an equivalent there. So if you have a $5,000 account and you want to trade the S&P, E-mini S&P, you would have to trade a micro lot, and you would have to be willing to uh, exit the trade if you're down $50, but each tick on a micro is just $1.25. So that's quite a few ticks before you get to uh, $50, and that would be equal to $500 on the E-mini. So it's relative and it's your knowledge, and that's why we're here today to help you understand this. So, in a summary here, futures start with at least, I would say, 10,000 or more to trade with proper risk management. In Forex, I would also, you can start with at least $2,000 to $5,000 because they have different lot sizes in the Forex asset class as well, with more capital. Providing a safer margin cushion, of course, is always best. And if you want to trade a standard lot in Forex, again, $10,000 would be a good place to start. The key is to start with an amount that allows you to manage risk effectively and to avoid over leveraging, which can amplify potential losses. And we're trying to maximize our gains and limit our losses. Okay. So to find the current CME futures margin requirements, including intraday margins for CME and CBOT products, the Chicago Board of Options Trading, you can access this information directly from the official uh, CME Group website or check with your broker who provides live margin data as well. Here's how you can do it. I'm going to take you to the website. Oops, excuse me. And you can see it provides up-to-date margin requirements for all products traded on its exchange. And you can find this information on the CME Group's margin requirements tab, which I will bring up here. Okay, so here's the CME Group, and we're going to look at, let's see here, the E-mini, and we'll see the E-mini S&P futures margins, and here's the margins tab here. And as I was saying, remember that $10,000 top of the range that we were historically comparing this to? But today, being March 4th of 2025, to trade one contract in a live account requires you to have 15,273 US dollars certified funds. So as much as you want to, I don't care how bad you want to do it. If you do not have 15,273 US dollars, you are not able to even trade the E-mini S&P contract, okay? Now, there's another way that you can do it, and that's through proprietary trading and prop firms. I'm going to touch on that at the end. Also, let's look at the E-mini NASDAQ. It's even higher, 22,808 US dollars today to trade one contract. So if you wanted to trade two or three contracts, you multiply that. So to trade three contracts, you're at $66,000. So these are some of the obstacles and hurdles that people have in even positioning themselves to trade the financial markets. So I'm so glad that you joined us today and you have an understanding of what's required and where to go. Again, that's the CME margin requirements on the CME Group's website. Okay. So additional considerations is a buffer. You know, when you trade, you do want a buffer. While you only need the intraday margin to open positions, it's wise to maintain additional capital as a buffer to avoid margin calls. And in case the market moves against your positions, because it will move against you, uh, you're not going to win every trade. If any athletes out here, I mean, I played sports, some of you played sports, and what does any great athlete understand? I'll let you answer that. You're not going to win every game. There's no way. The best athletes have winning days and losing days. The key is to lose properly and professionally. And to do that, you have to have calculated in your mind, I will lose no more than $500 on each and every trade, or $300 on each and every trade, or $250 on each and every trade. And you get out of the trade if you hit that threshold and you reset, assess the charts again, and you look at your strategy, you see where you may have been wrong in your thesis, and you re-enter the trade properly and appropriately when the opportunity presents itself. So, and here on leverage, even though the required margin might seem manageable, leverage amplifies both gains and losses. So effective risk management is key. So just because forex brokers give you 50 to 1, $50,000 of capital available for every $1,000 invested, it doesn't mean that you take all of that margin. So, you know, if you have uh, a $10,000 account, you don't put all of that $10,000 on one trade. You know, you don't have to put it all at risk, because if you're wrong, you could have significant losses. And if you're right, well, you're right, but there's no guarantees in trading, as we explained in our risk disclosure, nothing is guaranteed. It's your skill set that will get you to being consistently profitable. Okay. For the most accurate and current data, please refer again to the CME Group's margin page or your broker's specific requirements. Hopefully, you've learned a lot, taken notes today. Again, I am your guardian angel with my co-host, the one and only Ben Samulak, my host and partner here and co-host. And we just want to thank you again for joining us today. Remember, plan your trade, trade your plan, and keep God in it. And oh, I did want to mention prop trading. Proprietary trading is analogous to, um, let me see if I can make let's say you're a barber and you're a trained beautician and or barber, you know how to cut hair. You rent, like you affiliate with a barber shop. You pay a small rental fee to because you're licensed to cut hair. You pay the owner or the owner of the firm $40, and then you can cut hair. You pay him $40 a month, and then you have access to cut the patrons that come into his shop. Well, the same concept with a prop firm. You pay the prop firm for a $50,000 account. You may pay them $20 to, these are just hypothetical numbers. For a $100,000 account to trade, you may pay them $40. For a $300,000 account, you may pay $70 a month. And that gives you access to their capital. Once you demonstrate proficiency in your trading, you can keep a certain percentage with most of these prop firms. And then and for giving you access, they retain a certain amount and they can follow your trades. Prop firms do this so that they can follow the best traders and um, take advantage of their skill set to provide capital because they're in the business of managing money and they want good traders to help them grow their uh, their capital and manage the risk. So that does it today. Thanks again and be blessed. We'll talk to you soon.